In this comprehensive guide, we'll explore the importance of building wealth, the challenge of beating inflation, the risks involved, and the difference between day trading and long-term investment strategies. We will also delve into the historical performance of the S&P 500 to give examples of average returns over extended periods of time. Building wealth. A focus on growth when it comes to personal finance. It's essential to strike a balance between saving and investing. While saving is crucial for emergencies and short-term goals, investing offers the potential for long-term wealth growth. By investing, you can harness the power of compounding and leverage the growth potential of different asset classes. The challenge of beating inflation. Inflation erodes the purchasing power of money over time. Therefore, it is essential to invest in assets that have the potential to outpace inflation. Historically, stocks have been one of the best performing asset classes to achieve this objective. Over the long term, equities have demonstrated the ability to deliver returns that surpass inflation rates. Historical performance. The S&P 500, an index representing the performance of 500 large US companies, provides an insightful perspective on long-term average returns. Over the past 10 years, so 2013 to 2022, the average annual return of the S&P 500 was approximately 13.6%. Over the past 20 years, it was approximately 7.3%, and over the past 30 years, it was approximately 8.5%. And over the past 50 years, it was approximately 10.4%. However, it's important to note that the past performance does not guarantee the future results. Understanding investment risks. Investing inherently carries risks, and it's essential to be aware of them. While historical performance can provide insights, it does not eliminate the possibility of volatility, downturns, or losses. Different asset classes, such as stocks, bonds, and real estate, carry varying levels of risk. Diversification, thorough research, and a long-term perspective can help mitigate some of these risks. Day trading versus long-term investing. Day trading involves actively buying and selling securities within a short time frame, aiming to profit from short-term price movements. On the other hand, long-term investing involves holding your investments for years or even decades with a focus on capital appreciation and compounding. Day trading can be challenging, requiring substantial time, expertise, and emotional discipline. It can yield high returns for skilled traders, but also carries a significant risk of losses. In contrast, long-term investing, often referred to as set and forget strategy, allows investors to capitalize on the long-term growth potential of the market while reducing the need for frequent decision-making. Compound interest explained. Compound interest refers to the process of earning interest on both the initial amount of money invested, known as the principal, and the accumulated interest from previous periods. It's a powerful concept that allows investments to grow exponentially over time. Here's how compound interest works. Let's say you invest £1,000 in an account or asset that earns a fixed interest rate. This £1,000 is your principal. At the end of a specific period, typically annually, the interest is calculated based on the principal amount. The interest rate is expressed as a percentage and can be fixed or variable. The interest earned is added to the principal, increasing the total amount of money. For example, if the interest rate is 5%, the £1,000 investment would earn £50 in the first year. In the subsequent periods, the interest is calculated based on the increased principal, including the interest earned in the previous periods. The process repeats over time, leading to exponential growth. As time goes on, the interest earned in each period contributes to a large proportion of the overall growth. This compounding effect allows investments to grow faster and accumulate wealth over extended periods. Some quotes for you now. So Warren Buffett, one of the world's most successful investors, famously said, "The stock market is a device for transferring money from the impatient to the patient." This quote emphasizes the importance of long-term perspective in investing. Investing in the UK offers an opportunity to build wealth and beat inflation. By adopting a long-term investment strategy and focusing on assets that have historically outperformed inflation, such as stocks, investors can harness the growth potential of the market. While risks exist, diversification and a disciplined approach can help mitigate them. Remember, investing is a journey that requires patience, research, and a focus on long-term goals. This video is part of my Money Management for Beginners series. Check out the whole course over here, like the video if you found it useful, and subscribe to not miss out on more personal finance tips. Thanks for watching. Bye.